All right, guys, how you doing? This is Coach Keyon, also known as Mr. Finance, your favorite financial educator and business coach. And today, I have the pleasure of where I'm going to be talking to you guys about a series of things pertaining to finance today. Okay, we're going to cover a lot of information today because when you think about your finances, right? One of the biggest issues is that we could be great money makers, we could be great money savers, we could be even become great at everything pertaining to our finances. But here's the thing: if you don't understand the fundamentals, then you will never understand how to go bigger and better. Now, everybody can give you an idea of how to make more money, right? Everybody can give you an idea of how to expand on money. But until we understand four things about money, which is making it, saving it, growing it, and protecting it, until we understand these four things and how you got to use the information and the understanding to make these things work simultaneously, then money gonna always be confusing. Money will always remain to be confusing. Because here's the thing: you can make good money. That's amazing. That's the first step. But how amazing are you at saving money? How amazing are you at growing what you're saving? How amazing are you at protecting what you have grown over the years? There's four steps that you got to master all four of them. And today, I'm going to talk about those four steps. And the first thing you got to understand is why you need to make more money, right? Because it's not just going out there and say, hey, let me go get a job or let me go start a business. You got to know why, right? So here's the four things. Let's talk about these four things real quick. Four things you must understand about money. You got to know why, you got to know how, you got to have a goal, and you got to have a plan. So if you understand these four principles about money, and you understand that I got to know why, how, a goal, and a plan. Now let me break it down to you what I mean by this. What I mean by this is this: why? Why I got to make more money, right? Why you got to make more money? You got to know that first. Second, you got to learn how to save more money. The goal is to grow that money. And the plan is to protect that money. If you don't have these four ideas in your head when it comes pertaining to your money, then you're in big trouble. So before I get started, let me just introduce myself a little bit for those that don't know who I am. My name is Coach Keyon, also known as Mr. Finance, your favorite financial educator and business coach, and now author, right? I'm the author of my newest book that is out called Master Your Budget using the 50-30-20 formula. It's on track to being a bestseller. It's available on Amazon. I encourage you to go get a copy if you want to become financially literate. So, one of the reasons why I got into this industry is because I wanted to change my life. I wanted to learn about finance. I want to position myself. I want to put my family in position and get the information so we can start applying it, especially in a bigger way, right? So when I became a part of this crusade over a decade ago, I joined a crusade just to learn about finance. But what inspired me to become an educator and a broker is because I wanted to position myself to give people the opportunity to learn and earn. And that's what motivated me. So, here I am. I'm a regional marketing director with HGI, and I'm a proud, system builder here. And I want to tell you guys that, hey, there's three things that I focus on in my program. I make sure that you get the education, I make sure that you get the financial planning, and I also make sure to get access to financial services. And if you're someone that's open to learning and earning on a part-time basis, if it didn't conflict with your current schedule, definitely get in touch with me. All right. But today, what I want to focus on is these four things: why, how, a goal, and a plan. If your financial educator, financial advisor, financial planner is not talking to you in this manner, they don't understand finance. Let me just put that out there right out the gate. All right. Because a lot of people talk real good, they sound real good, but if they can't give you a simple understanding of what is that you need to focus on, you got to focus on these four principles: why you need to make more money, how to save more money, goal to grow your money, the plan is to protect it. What's the use of making it, saving it, growing it, and you never protect it? That was a whole waste. You don't want to be that person. That's where a lot of us have a whole lot of memories and so little legacy have passed on. Everybody have the story about the rich aunt, the rich uncle, the rich whatever. But how many of you have the story of that one person got rich and we stayed rich? That's the difference between being a memory and a legacy. That's the difference between your last name being like the Rockefellers and if it's gonna be no fella, right? You gotta understand these fundamentals, and that's why I'm here to talk to you guys today. So we're gonna talk about why to make more money, how to save your money, the goal to grow your money, and a plan to protect it, and how you do that. So if you got a pen and paper, I highly encourage you take really good notes because I'm about to give you some valuable information today that you could take with you and apply them at every given time and any given moment. All right. I'm about to change your life today in a matter of just a couple minutes. So first thing we're going to talk about why. When someone says I got to make more money, why I got to make more money, right? Is because they understand what is called their fin. They know their fin number. If you ask 10 of your friends currently right now, do you currently know the fin number? They have no clue what you're talking about. They probably think you meant the end of a movie. Okay? No. Your fin number stands for your final income number towards your retirement. Let me ask you this. Are you working just to pay bills? Are you working just to spend some money and have a good time? What is the end goal? If you don't even have an end goal in mind, if you don't even know a number that you're trying to accomplish at a certain period of time, then you, my friend, have no financial literacy. There's no way you can sit here and say, I'm going to work and I'm going to save some, invest some, but you don't even know how much you need to get to and at what age. Everybody keeps talking about retirement at 65. Who gave you that number? Why would you believe that you should work from 40 to 65 or from 30 to 65 or from 20 to 65? Why is it that you keep repeating 65? Why? Do not fall into the trap. Because if you knew your fin number, you wouldn't spend the way that you do. You wouldn't go about the life that you do. You would change how you live your life. And I want to bring that awareness to you so you have a choice. But let's break down your fin number. What is your fin number? Write this down. Your fin number stands for your final income number when it comes pertaining to your retirement. If you don't know two things about your retirement, you don't understand retirement. Let me break this down. If you don't understand what you need in order to retire, and if you don't know how much you need to save in order to retire, then you don't have a retirement plan. It's that simple. Very much that simple. So once again, if you don't know what you need in order to retire, if you don't know how much you need to save in order to retire, you do not have a retirement plan. Everybody could tell me where they're saving it. Everybody could tell me what age they want to retire, but no one could never tell me how much money they desire. That's the problem. And if you don't realize that's a problem, then at 65, you're going to have a problem. At 45, you're going to have a problem, right? So let's eliminate that problem today. First thing we got to know is 3 events in your life. Number 1, you got to know the now. Number 2, you got to know the later. Number 3, you got to know the end. These are 3 events in your life that you got to plan for, my friends. 3 events you must plan for in your life. And if you don't plan for these 3 events, then your future is going to be really sticky and rocky when it comes to your retirement. Now, what do these 3 events represent? Now represent your current age, okay? Now represent your current age. Later represent your retirement age. The end represent your life expectancy, okay? I'm going to say that again. Now represent your current age. Later represents your your retirement age, and represent your life expectancy. Okay, these 3 events you must plan for in order to continue winning the money game. So let me give you a breakdown what this means. Let's use an example. Okay, they say that the average individual starts saving for their retirement at the age of 30 years old. That's their current age now. The average person starts saving for retirement at the age of 30 years old. Did you also know that the average person believe that 65 is the age to retire with an income coming in of $5,000 every month. All right, 5,000 coming in every month. That's about $60,000 a year. So that's what the average person believes, that $5,000 coming in at 65, $60,000 every year coming in is sufficient. But the average life expectancy for someone is 85 years old. Okay, 85 years old. Now, when you do your FIN number in this manner, then you understand, okay, what is it that I need and how much I must save. Let me give an example. If we was to go off the average, right? If we was to go off the average, when the average person starts saving for retirement is at 30 years old, the average person desire to retire at 65, and the average person life expectancy is 85. If you planned your life out like this, let me give you a glimpse of what it will look like. And then you got to ask yourself, are you on track? Let me give you this. If the average person desired to have $5,000 coming in at the age of 65 years old, which is for 12 months per year, that is $60,000 per year that they need. So from 65 to 85 years old, this individual will need $60,000 coming in for the next 20 years. From 65 to 85, that's a 20 years of needing 60,000. So when you do the math, 60,000 multiplied by 20, that means that the average individual needs to have $1.2 million. $1.2 million saved up in their retirement plan. Right? 1.2 million. So let me ask you this question. Let me come a little closer, and I want to ask you this serious question. How many of you right now is watching this, is on track to have $1.2 million saved up by the age of 65 in your current retirement portfolio? How many of you have $1.2 million and will be on track to have that type of money in your portfolio? If you're that person, comment below. If you're that person, like this video right now. If you're this person, share this video right now. And if you're not that person, you need to get in touch with me. Because if you're not on track to have $1.2 million at the age of 65, in order for you to receive $5,000 every month, $60,000 every year for the next 20 years from 65 to 85, then you're not even on track to have a retirement that you truly desire. What if you want more than 5,000? What if you live past 85? What if you want to retire at 50 and not 65? The question you got to ask yourself is, are you on track? Are you on track? Are you in a position that you're going to be able to retire with the income that you truly desire? But then, how would this $1.2 million be taxed when you start to receive your $5,000 every month and you start withdrawing $5,000 every month, $60,000 a year? Would that money be taxed now, which means the money will be taxable? Would that money get taxed later, which means that the money is tax deferred? Or would that money get taxed never, which means that, hey, I'm receiving tax advantages? That's another crucial planning in your retirement planning. You got to also ask yourself, what is going to be your tax tolerance upon your retirement? And you got to ask yourself, what is your risk tolerance upon your retirement? Is it going to be in a secure account or is it going to be an unsecure account? These are all things you must understand when it comes to your retirement plan. And why must you understand this? It's because the goal is to work hard and smart, but in order to enjoy our money responsibly. That's the reason why I wrote this book. Because this book at least gives you a glimpse on how to save that money. Okay? So when you realize that, hey, I need $1.2 million, and if you're at age 30 and you know you need $1.2 million, right? You need $1.2 million. And you have from age 30 to 65 to save for that. You have 35 years to save that funds. This means that you would need to save at least $34,000+ a year or $2,800+ a month. Okay? Let me ask you this. For all the 30-year-olds that's out there right now, if you're 30 years old, I need you to listen to me right now. Can you save that type of money right now and still pay your bills, have a lifestyle, and if you have children and a family, to take care of them? Can you save $2,800 every month and still take care of your family at the same time? And if you can do that, comment below. If you cannot, we need to talk ASAP, right? It is very, very crucial, because here's the thing. This is why I said that most of the time we were set up to fail. If you're a 30-year-old right now watching my video, or if you're older, you definitely need to talk to me. But if you're that 30-year-old that's getting in that job market and someone says, save your money in the bank, that's the way majority of the people save their money. A lot of people save their money in the banks and CDs. And you got to realize that you have 35 years before you reach 65. How are you going to be on track to have $1.2 million by the age of 65? If at 30, it requires you to put away $2,800 every month, over $34,000+ every year, on top of your monthly expenses and the life choices that you choose to live. How can you do that? And that's the reason why I want to introduce you to something right here real quick. This is just an idea. You could take it or you could leave it. I want you to think about this. What if you start learning how to take your W-2 and fund a 1099? What if you take this W-2, invest it in a 1099 until that 1099 can replace that W-2? Now, you may ask yourself, what is a 1099, Keyon? That 1099 could be one of two things. It could be a business. That's one. You can invest it into a business. Or two, you can invest it. So you can either invest it into a business, start a business and a part-time business, or you can invest it into multiple businesses. Did you know that you can invest your money into things like the S&P 500, where you get access to over 500 of the top financial company businesses that's in the US here that is thriving and winning? Did you know that you could invest your money into indexes, right? Like the S&P 500, the NASDAQ, the Dow Jones, right? Where you get access to multiple businesses, where you go become an owner, or you could start a business on a part-time basis. That's one of the great things that our firm offers, those opportunities for people that wants to learn and earn. We're always expanding. We're always expanding. And that's why people come and be a part of our brokerage and start their own financial brokerage and offer financial services, financial education, and financial solutions. So if that's someone like you that wants to learn and earn at the same time, we're always looking for you. So that's the reason why it's important to understand why I got to make more money. Because if you look here, if you're 30 years old, you have 35 years to save $1.2 million. So you can have $5,000, $60,000 a year for the next 20 years, from 65 to 85 on an average. And then you got to ask yourself, when you start to take distribution, how is this money going to be taxed when I start needing it at a time of more important? I want to give you guys a word of wisdom. Did you know that if you're paying taxes at the time when you need to retire, that means your retirement was not set up in your best interest? And then you got to ask yourself, whose interest is it for you to pay taxes at a time when you're no longer working? I want you to think about that. But like I said, this is the why you need to make more money, right? This is why. Now, the next thing we're going to talk about is how. All right, we're going to talk about that how. And the how aspect of things is important. Now, if you want to learn how to save more money, then you must take the time to learn the very same thing I wrote a book on, the 50-30-20 formula. This formula is not something that I invented. I just got really good at it over the past decade, and I taught a lot of my families and business partners and clients and students over the years how to use this simple formula to learn how to save their money and how to budget it. I teach people how to master their budget by using that simple formula right there. That formula helps you to know, because one of the biggest misconceptions about budgeting is that in today's society, we were taught that budgeting is about tracking spending. And budgeting is not about tracking spending, because the fact that it even encourages you to spend without knowing how much you should spend, that's a problem in itself. Budgeting should be based upon knowing how much can I spend and how much can I save before I do either one of them. That's how you know what to track. Because if you can't track what you don't know, okay, write that down. I cannot track what I do not know. And you got to know those two things. How much can I spend? How much can I save before I do either one of them? That's what budgeting is all about. Now, let me break it down to you what budgeting looks like when you master your budget. Two things you must know about budgeting before you do either one of them, guys. I'm giving you guys some vital information. I'm telling you right now, like and share this. All right? Like and share this right now, because what I'm giving you, most people have to spend thousands, 500 or more just to have someone sit down with you and break this down to you, right? And they probably don't even do it half as good as I am. So I just want you guys to like and share this. Share this knowledge with someone. Do not just keep it, all right? Share it. Share this and say, hey, watch this guy and listen and follow instructions. And you can take notes as I go, okay? Here we go. Now, when it comes down to the 50-30-20 formula, two things you must know before you can start the formula. Number one, you must know what is your total net pay. All right? You need to know what's your total net pay. If you're a W-2 worker, this is the money that you get after taxes. Okay? If you're a W-2 worker, this is the money that you take home after taxes. You need to know what is that on a monthly basis. What is your monthly net pay? Now, for all my folks that are entrepreneurs now, all right? For all my entrepreneurs, it's a little different, because there's entrepreneurship. We can make a lot of money one month. We can make a little money all month. What I got to know is, how much do you need in order to take care of your monthly expenses and take care of your lifestyle, right? You need to know that. So when someone asks you, what is your goal every month? You got to know, okay, my goal is to make this much money every month, right? And that's your net pay. So what is your goal every month? For example, my monthly expenses is roughly around 5,000 every month, right? This puts me in a position that if I want to save $1,000 and still have a spending budget of $300, this means that I need to make at least anywhere from $6,300 to $7,000 every month in order to be able to take care of my expenses and still save about $1,000 and have $300 as a spending budget, right? That's just to give you an idea, all right? So as an entrepreneur, you got to look at it from that expense rate and profitability, okay? So once again, what's your net monthly income? You just got to write that down. You got to know it. The second thing you got to know, what is your monthly expenses, right? What is your monthly expenses? What is your bills? What is your cost of living? You got to know those two things right there. Now, here's how you break down this one, because this one is very crucial. My book talks about this a lot, right? When you're doing your monthly expenses, you got to know the difference between your wants and your needs, all right? Now, your monthly expenses should be, build up on all of your necessities. Now, if you do not know what your necessities are, it's very crucial for you to know them. But before you can even get to that part of things, you got to look and see in your account. We do what's called an audit. All right. You got to audit your account. When the last time you audit your bank accounts and your credit cards? When the last time you audit your account? If you're not auditing your account every month, every quarter, I promise you, you are spending money that you didn't plan to spend right now. You know that I help my clients identify anywhere from $10 and upwards up to $300 of unexplained spending that they were doing, from subscriptions, different things that they were just buying. They didn't realize it, or it was on recurring, right? Withdrawals. They didn't even remember. One time I had a guy that had three Netflix accounts where he was spending upwards of $14+ on each one. And he didn't even know. that his account was withdrawing 3 separate Netflix accounts. Okay? So you got to know how to audit your account. So how do you audit your account? You got to go back 3 months, right? 3 months in your account. Go do a look back. 3 months back in your account, and I want you to look 3 months backwards and start identifying all the people that's taking money out of your accounts. All those bills that's withdrawn or on recurring, you got to get a highlighter, right? So print off 3 months of your bank statements. If you have things that's being taken off your credit cards as well, go print off those statements and literally get like a highlighter and go through each one, highlight them, highlight them, highlight them. What you want to identify is who's taking money from my account and why they doing it, right? Here's another thing you must know. When you do your monthly expenses, we're going to break this down. When you do your monthly expenses, 3 things you must know. Number 1, you must know the name of who's taking money from your bank account. That's number 1. Number 2, you must know how much is the amount that they're taking from your bank account. And then number 3, you got to know what is the due date. All right? What is the due date that they're taking out this money out of my account? If you don't know these 3 things about your monthly expenses, you have no idea what is your real monthly expenses. Do not just be the person that say the money is there, take it. You got to become very much conscious about your money. You got to become conscious and aware of your money. When the last time you check your bank account? Are you the person that check your bank account daily? Do you know the activities that are happening in your account every day? Do you pay attention to these things? You know, you got to have these type of money consciousness where you check your account every day and you audit who's taking money from your account from yesterday to the morning you wake up. And before you go to bed, check it again because you just never know, right? Back in the days, our parents used to call it balancing your checkbook, right? But you got to get really good at that. You got to become very money conscious, all right? So remember to know these 3 things about your monthly expenses: the name, the amount, and the due date. Go audit your account right now. You'll be surprised what's in there. Once you know those 2 things, your net pay, your monthly bills, and the amount, that will help you. But let's go off of monthly income, right? I'm gonna try to keep it as realistic as possible. Let's say that you have a monthly income of say $5,000, right? You're bringing home about $5,000 every month. Let's say that your monthly expenses is roughly around say 4,500, right? $4,500. Now, what is very evident in this area? One, your monthly expenses is too high, okay? But let's say that this is your reality. Your reality is that you make $5,000 every month. Your monthly expenses is $4,500. What is very clear in this example? You could pay your monthly expenses, hands down. That's not the issue here. Making money to pay your bills was never the issue. Remember, your issue when it comes to your budgeting is knowing how much you can save and how much you can spend. It's never been about, can I pay my bills? Your problem with your budget is that you always have an issue with, how can I know how much I save and how much should I spend? Do you know that in today's society, most people undersave and overspend? They undersave and they overspend. Why? Because they will justify a want and make it seem like it was a need. It's an impulse. It's an impulse that is built up in our society due to the fact that we live in the country that is not known for being the number 1 savers, but we are known to become the number 1 consumers. Our economy drives us to spend our money, not to save our money, because our economy is built upon our money constantly circulating, which means that it's either you're circulating it by owning investments or you're circulating your money by spending it. See, I don't have a problem with spending. My book talks about this. I don't have a problem with you spending your money, but you got to know how to save the principal, live off the interest. I'm going to say that again. Save the principal, live off the interest. Or better yet, invest the principal, and live off the interest that is earned. You got to become this way because that's how wealthy people spend the money. So when you see wealthy people buy Range Rovers and Land Rovers and all these things, they're not doing that because they just want to go out there and spend money, guys. They're doing that because they put their principle to go to work so that way they can enjoy the interest that it came back and then they go spend it. All right. So this is how you got to do it. You got to do what the wealthy do. So let's break this down. How do we break down this using the 50-30-20 formula? Well, here's some rules. You got to know the rules to the formula. The formula said that 50%, right? The 50 represent 50%. 50% of your income should cover all of your bills. All right, let's make that very clear. 50% of your income should cover all of your bills. That's the first thing you got to get very known for. Now, you got to think about what is all of your necessities, right? What are all of your necessities? Do your monthly income cover all of your necessities? Because if it doesn't cover all of your necessities, then what is the problem here? We got to change that, right? We got to change that, and we got to change that in a major way. So you got to ask yourself, what can I do to cover 50% of my income? 50% of my income should cover all of my monthly expenses. You got to get really better at this, right? And I want to encourage you guys to do this so that way we can continue winning that money game. Because if we don't, then we're going to be in trouble. It also says that 30% of your income should cover your wants, right? It should cover all your wants. So if 50% should cover your bills, which is your needs, 30% of your income should cover all your wants. And then it says the minimum you should save is 20%. Now, here's something that I also explained in my book. You can switch these two around right here. If you don't feel the need that you want to spend more money than you're saving, you could switch that. You could make 20% go towards your want and 30% that you save. You could switch it. You could make it even 40-10. What I'm trying to tell you guys is that I want to encourage you to save your money. Save. Save from time to time. Because the money that you save today will be the money that saves you tomorrow. Save the money today so that way the money will be there to save you tomorrow, right? It's very, very crucial. Very, very crucial. So if now that we know the rules, let's talk about the formula. What is the formula? You're always going to take what's called your net pay, all right? You're going to always take your net pay. You're going to multiply by each one of these percentage, and that will equal the money that you need for each category. So let me explain that again. You're going to always take your monthly net pay. You're going to multiply by each one of these. That could be a 0.5, 0.3, 0.2, and it will give you the money that you need to pay the bills, you take care of your wants, and to save. And that's how the formula works. So let me show you what it looks like in action if we're going to use this example. If we're going to use this example of you making $5,000 every month, your monthly bills is $4,500, all you're going to need at this moment is a calculator, guys. You just need a calculator. You don't even have to figure it out. I'm a proud advocate of calculator, okay? So in this case, you can get your calculator. Now, if you're following me right now, if you're following everything that I'm doing and you're working on yours right now with me as we're doing this, awesome, right? You may not use the 5,000, but if that's 5,000, your income, your expenses is 4,500, great. But what you want to do is find out those two things first, and then you're going to follow step by step what I'm going to do next, all right? Let me show you how I do this. So what I do to break down this entire formula, you can use these 4 boxes if you like. You don't have to, but I just like using the 4 boxes because it makes things a little bit neater. All right, you're going to draw 4 boxes just like this. Can you imagine, guys, your budget could take you literally about 4 to 5 minutes to figure it out if you follow everything that I'm sharing with you today. Now, the first thing you're going to do is label each box, all right? You're going to label each box. The first box is called your needs box, all right? This is the needs box. That's the bills box. The second box will be the want box, all right? The third box will be the savings box, all right? And the fourth box is called the result. It's the result box, all right? These are your 4 boxes. And like I said, we're going to apply the formula. We're going to take the net pay, multiply it by the percentage for each category. So for this example, if our net pay is 5K, so we're going to pay $5,000 in each box, right? $5,000 in each box, $5,000 in each box. Now we got 5,000 in the 3 boxes that we got to figure out where the money is. Then we're going to multiply the needs box by 0.50 because that's the 50%. In the want box, we're going to multiply by 0.30. That's the 30% towards your wants. And then in the savings box, we're going to multiply by you guessed it right, 20. All right? You're going to multiply by 20 here. So once again, when you get your calculator, yes, I know 5,000 multiplied by 0.50 is $2,500, but it's the same thing you put in the calculator. You put in $5,000 multiplied by 0.50, that gives you $2,500. All right? So now you got $2,500 here. First thing we got to do, we got to check in real quick. We got $2,500 on the board. First thing we got to check in is, can the 50% of my income cover my total monthly expenses in this example? Absolutely not. $2,500 cannot cover that $4,500 bill, which means that 50% of my income cannot pay all my monthly expenses. This means that you're in trouble. But don't worry nor fret. Did you know, I want to give you some statistics. Did you know that 95% of Americans cannot pay their total monthly bills with 50% of their income? Did you know that? Which means that it's only about 5% of the population that can do this. Now, if you're someone that could do this, you're part of that 5%. But 95% of Americans cannot pay their entire monthly expenses with 50% of their income. Why? Because over the years, we have inflated our lifestyle by acquiring more debts that we call assets. Robert Kiyosaki said it best. He said that if you want to know the difference between assets and liability, he said assets put money in your pocket, liability take it from it. So you got to ask yourself, what kind of liabilities you have acquired that you believe that are assets? Now, let's move on. Now we got 5,000. 5,000, again, multiply by 0.30. That gives us $1,500. Now, let me ask you guys this. Do you think in every given moment of your life that it's okay to spend $1,500 every month if you don't even know your PIN number? Do you think for 1 second in your I'm talking about financial maturity right now. Do you think it's okay in any given time, middle class, lower class? Do you think that it's ever okay to spend $1,500 every month on your wants when you know that on an average, you need to have $1.2 million saved up by the age of 65 in order to receive $5,000 every month, $60,000 every year for the next 20 years from 65 to 85, $1.2 million that's needed? Do you think it's appropriate for you to be spending $1,500 on your wants in any scenario? Something you need to ask yourself, right? I want you to think about that. Then when it comes to the savings box, once again, take $5,000, multiply by 0.20. That gives us $1,000, right? $1,000. Now we got the entire money on the board. When you add up 2,500 plus 1,500 plus $1,000, that's $5,000, right? That's $5,000 right there. Now your money's on the board. But now what we have to do first, we got to take care of this monthly expenses right here. This monthly expenses have to be taken care of. Now, the question you got to ask yourself is this, guys. If you couldn't pay all your bills with 50% of your income, where should you take the money from? Should you take the money from your savings box or should you take it from your want box, right? If you're smart like me, I know you're saying, hey, coach, take that money from the want box, right? Great, you're correct. So the first thing we got to do is eliminate all funds from this box right here, right? We're gonna eliminate all of that, zero that out. We're gonna bring that 1,500 over here. Now we're left with right here, and then we got 4,000, right? So we got 4,000 in the needs box. Guess what? The bills still can't be paid. We're short 500. In this scenario, most of the time, this is what your finances look like, where you have to go into your savings, because even when you eliminate your wants, your bills still can't be paid. So it forces you to go in that savings box, right? So you had the desire to save $1,000, but your budget said no. I could really only save about 500, because you got to take this $500 and you're left with $500 left over. Now you bring this 500 up here. Guess what? The bills is paid. Your bills is paid. But you only got 500 here. Now, someone asked me once and said, Coach, is it really okay? Are you trying to push the idea that what I need to do is that I got to work and just save money and I don't get to have fun? That's all I have to do? And I'm here to tell you, absolutely not. I'm not even a big fan of even telling my clients, my students, my business partners that you need to eat bread and butter for a while so you can sacrifice and reach the top. Absolutely not. What I'm trying to say is that if you like steak, you may not be able to eat steak every week, but can you cut it down and eat steak once a month? Can you eat steak on a budget? Can you eat filet mignon on a budget? Can you eat the crab legs on a budget? Can you eat duck on a budget, right? You got to be on a budget. You know, one of the things that I always ask my family is it in the budget? Right? Is it in the budget? You got to get really good at that. When someone invites you out and they say, hey, can we go do this? Man, listen, it's not in my budget right now. You should not be ashamed to say, I don't want to spend money. That's what makes you financially responsible. You have to become financially conscious and responsible. You must know when to say no, because your FIN number is more important than going out there and giving away your money. You got to ask yourself, am I an investor or am I a consumer? You got to ask yourself, which one are you? Are you an investor or are you a consumer? Consumers get sold to, investors buy from, right? They buy the company. They don't get sold from the company. You got to ask yourself which one you're going to be. So when it comes to the result box, I'm going to introduce you guys to a formula that I created over the years. It's called the half rule. All right. I want you to write that down. It's called the half rule. And it's simply just breaking down this 20. It's called the 10, 5, 5. All right. 10, 5, 5. All I'm doing is breaking down this 20 right here. Right. Because what I'm saying is that, hey, 20 equal 500. Right. That's what this formula just said. 20 equals 500, 10, 5, 5. Do you realize all I did was divided by 2? That's all I did. So all you have to do is come right here and do the same thing. You got to come here. If you want to know what is 10, take that 500 divided by 2. That gives you what? 250, right? So what do you do with this 250 here? This 250 is the funds that you take and you go build a stronger financial foundation with it, right? You start to invest that money in your financial foundation and you start to save and invest that money. You got that 250 to do that. Now, for you to find out if 10 equals 250, then what is 5? Well, take that 250 right here and divide it by 2 again. You take that 250 divided by 2, that gives you 125. Right? 125. This 125 is what you put aside in your emergency funds. All right? This 125 is the money that you're going to put away in your emergency funds. How many of us have an emergency funds right now? How many of us have an emergency funds? Right? This is something that we have to always rebuild because emergency is going to happen. Did you know that if you use your credit card as an emergency fund, it actually will hurt you more than it'll help you? Now, if you have no other choice, I understand. I don't knock you. That's why we're trying to put this thing on a budget where we can put together emergency funds. Now, how much emergency funds you need to have? Write this down. You need to have at least 3 to 6 months. 3 to 6 months of emergency funds set to the side for those unexpected moments where emergency may happen. 3 to 6 months. And if you put aside your funds for the next 3 to 6 months, then you'll be on track, okay? Now, the other 5, which is the same 250 divided by 2, that gives us 125. Now, this is the funds that you can use to spend, or you can apply towards your debt. If you have debt right now, did you know that if you could put aside an extra $50 to $100 towards your debt every month, do you know that you could pay off your debt at least 2 to 3 years faster than the schedule that you have right now? You could pay it off much faster. So that's what makes this so crucial, and it's so important for us to really learn these fundamentals. So once you understand all of this, guys, once you know all the funds, right? You can see all the money. Let's break it all down. Let's break down all the money that we just discovered. Number 1, we discovered the income, your monthly income, which is $5,000. Number 2, we discover what is your monthly bills, which is $4,500, right? Number 3, we discover how much money you can save or invest, which is $250. Number 4, we discover how much money you can put towards your emergency funds, which is $125. Number 5, we just discovered how much money can you spend or put towards your debt, which is also another $125. Now you got all this money. This is what you're tracking, guys. This is what you are tracking. You're able to track my income, my bills, how much I can save and invest, how much I can put aside towards my emergency fund, how much I should be spending or put towards my debts, right? That's what's make this so magical, guys. It makes it very magical and practical. Now, if you want to get more technical about this, if you're someone that get paid every 2 weeks or every week, you're just going to divide all these numbers here, your income, your bills, your savings, the emergency funds, how much you should spend, divided by 4 or 2. It will tell you when you get your check how to start divvy out the funds. All right? How to divvy out the funds. That's why it's so important to learn how to save and how much you should be spending. If you don't know those 2 things, you're not budgeting. And that's why I encourage you, go get my book because it breaks that down. So now once you know how much you can save and how much you should be spending, what's the next plan? Next plan is to what? A goal. You got to have a goal now. What is the goal? The goal is to build a stronger financial foundation. That's the goal. So if the goal is to grow your money, that's the goal. Let's write that down. The goal is to grow. Write that down. The goal is to grow, which means that you need to create a stronger financial foundation, SFF. You need to build a stronger financial foundation. If you want to build a stronger financial foundation, here's what's really important for you to understand. Number 1, you got to understand that first, you got to look at it like a house. I'm going to draw a little house for you here. Don't make fun of my drawing, okay? You got to have a house. And on that house, you got to have a foundation, right? And if you have a strong foundation on your house, what that means for your house, it won't get knocked off, it won't get blown away, it won't slide or whatever, right? But as soon as you have a strong financial foundation, you also need to have strong beams, right, to hold up that house. You got to have a strong beam to hold up that house. But when you create that beam on that house, that infrastructure on that house, then you can apply the roof on that house, right? You can apply that roof on the house. Now, once you build your house like this, What does that mean when it comes to your finances? Well, the first thing you got to have is proper protection in place. That's your foundation. Proper protection. We're going to talk more about this, what this means. Proper protection. You got to have proper protection on your house if you want it to be solid. You can't build your house on something that is not proper. You got to have a proper protection to have a stronger financial foundation. And we're going to talk about what that looks like shortly. The second thing you have to have, which is one of these beams right here, right? You got to learn how to manage your debt management, right? You got to learn how to have debt management. How do you manage your debt? One of the biggest mistakes many of us make throughout our career is that we go broke trying to be debt free. Too many of us go broke trying to be debt free. And the only person that helps is is the very people's money that you used up. You got to learn how to manage your debt, because let me tell you something. You need debt in order to acquire assets. I'm going to say it again. I know that might went over someone's head real quick. Let me slow it down for you, the ones in the back. You're going to need debt in order to acquire assets. You need debt to acquire assets. Okay? Now, let me tell you what I mean. The very money that you use is not money. It's legal tender. That money haven't been money since 1971, ever since they took it off the gold standards, which means that your money is backed by nothing. It is debt to people that is public and private. It says it on that fiat currency that you hold right now. Did you know that today we could buy our country's national debt? If you go to treasury.gov, you could buy the US debt. So you just got to get really good at managing debt, right? And manage the debt that you're acquiring through liabilities. There's good debts and bad debts. When you take out a mortgage, that's a debt. Did you know that when you take out a loan, you pay no taxes on loans? Why do you think you pay no taxes on your mortgage? Well, you pay property taxes, not taxes on your mortgage. You only pay interest on your loans. You don't pay taxes. But like I said, that's a whole nother class if we get too advanced now. But let's go back to this. That's the second foundation in your house. The next thing you got to have is an emergency funds, right? The E funds. Emergency funds. That's the other beam of the house. You got to have an emergency funds, at least 3 to 6 months. At least 3 to 6 months of your income set to the side to have a that emergency funds. You got to have that, right? Because like I said, your credit card is not an emergency fund unless it's your only last option. Just know that your credit card is a really glorified loan. All right. Your credit card is a glorified loan that is way higher than most loan sharks, to be honest. Some people's credit card interest rate is through the roof. It's almost like getting a store card. You ever see those store cards and they got like 39.9%? That is ridiculous. If you understand the rule of 72, you should never get a store card that the interest rate is over 20%. You should not ever own a card that's over 20%. Because if you understand the rule of 72, you would never do it. Or you shouldn't do it, at least. Now, when it comes down to your roof is the money that you save / invest. This is the money that you save and then you invest it. Right? That's the money that you save and invest. But there's two things you got to understand before saving and investing your money. You must know what is your risk tolerance, meaning that you need to know the difference between being a conservative. You got to understand what it means to be an aggressive investor. You got to know what it means to be a moderate or a moderate growth. You also got to know the difference between secure and unsecure accounts. All right, when you're going to become an investor and a saver. You also got to know what is your tax tolerance. You got to know what is your tax tolerance. You got to know what it means to be taxable and how does that make your money become taxed now? What is capital gains tax, right? What's depreciating tax? You got to understand these things. How about the fact that you got to know what is tax deferred? What does it mean to pay taxes later on? What does it mean to be deferred, right? And how to get those deductions. You got to learn about tax deferred. Also, you got to understand what it means to get tax never. Why does it get tax advantages? What does it mean to receive tax advantages? Why is it that the income is deferred when you pay no tax on gains, or you pay no tax when you withdraw, or even some scenario when you pass away and your families receive it tax free? All right, no inheritance, no estate tax. You got to understand tax advantages. There's a lot of them. You got to understand them all. So this is what your house should look like when it comes to your finances. Proper protection is the foundation of your house. The structure that goes up is between having structure on managing your debt and creating the emergency fund. So that way, when you start to save and invest your money, you start understanding the difference between secure and unsecure, which is knowing your risk tolerance and tax tolerance. You got to know how your saving and investing won't affect you, but it will actually uplift you. You got to understand this, right? So just to give you an idea of what does proper protection look like, there's four things you need to have. Four things you must have in place. Write this down. Draw these four boxes. All right? Draw these four boxes, guys. I hope you're learning a lot. If you're learning a lot right now, say me, right? Comment me if you're learning a lot right now. Four things you must have. Number one, you need to have life insurance. All right. You got to have life insurance. That's the first things you need to put in place, life insurance. Now, some people will argue with me between this and say, Keyon, is the first thing I need to have is life insurance or estate plan. You could do either one. If you want me to be technical, let me be technical with you guys because I've had this debate with people before. And here's why I'm going to go down the scenario with you guys. Picture this. Imagine that you said, hey, Keyon, let's start with estate planning first. Did you know that estate planning take a while for it to be structured and to actually be formed while you could have been waiting? So I never really say that you need to get one at a time, but if you was to ask me which one you should put in place first, I would say life insurance. Because God forbid you pass away, at least you know that the life insurance would avoid estate tax and whatever funds that is issued out to your family and your loved ones, your beneficiary, would not have to go through probate court. That's the reason why I say life insurance need to be number one first. And then we could talk about formulating estate planning. Because yes, it's better to have your funds go into an estate plan, but at least you know if you died without a plan, your family won't be taxed upon the money that they're receiving, regardless. Okay? That's the reason why I always recommend life insurance first. You put life insurance first. But should it be something that you do first? No, it's something that these things need to be done simultaneously. When you put together a stronger financial foundation, these are the four things that you need to put in place and formulate very quickly. The next thing you got to do is life insurance, and then you got to work on health insurance, right? You got to work on health insurance. You got to have that in place. Now, when it comes to your health insurance, you got to know the difference between HMO and PPO. You got to know what is your copay and what's your deductible. You got to know these things when it comes to your life health insurance. Just like when it comes to life insurance, you got to know the difference between own and final expense insurance, which is the only insurance that pays out within 48 hours of you passing away. You also got to make sure that you have a term insurance that will protect all your dime, which is your debts, your income, your mortgage, and your educational planning for your children. You got to make sure that you have an IUL at the same time. So that way you can start to save the difference. You could put that money inside of your IUL where you can get the growth on your money. You could have the safety on your money. You will also have the protection, which is the living benefits that's attached to it for any terminal, chronic, or critical illnesses. And you also will have the tax advantages, which means that you pay no tax on the gains, you pay no tax on withdrawals, you pay no tax on the loans, and your family will pay no taxes upon the death benefit when you pass away. That's the reason why you got to structure your life insurance properly when you're owning them. Also, when it comes to the third one, you need to have LTC. All right, LTC insurance. What is that? Long-term care. You got to have long-term care insurance. If you don't have a life insurance that have living benefits attached to it, you got to plan for disability insurance. You got to have that in place. That's one of the things you got to plan for, because here's the thing. It's not a matter of if you die too soon, right? It's a matter of you live too long. If you live too long, and God forbid you start to get sick, like you get any chronic, critical, or terminal illnesses, and you need someone to come in like a nursing aide, a CNA, or a living assistant, or you need to be in a nursing home, who's going to pay for that? And if you didn't put things in place and now you want the government help and you didn't do what's called a 5-year look back, where you move all your assets out your name 5 years prior to applying for Medicaid or Medicare, then you're going to be in trouble, because now you have to surrender all your assets to the government if you want them to assist and help you. But that's a whole nother conversation that we need to have, right? If you'd like to learn more about that 5-year look back and how to plan for that, we could talk really soon. Now, fourth thing, you need to have an estate plan. All right. And most people believe that an estate plan means that I just have to have a will. Absolutely not. When you put together an estate plan, you need to have 4 things. This is just the 4 simple things. Number 1, you got to have a will. All right. You got to structure your will. If your wishes are not in writing, it was never said. Every wish and every desire that you have, you need to put it in writing. It needs to be in a will. Once you formulate a will, you need to apply what is known as a power of attorney. A power of attorney is someone who can make decisions for you when you're no longer competent, or if you're not conscious to make decisions for yourself. You need to appoint someone to be your power of attorney. If you do not have a power of attorney, the state can sometimes be the person that makes decisions for you until your family fight for that position. And trust me, 9 out of 10 times, you don't want the state to be your power of attorney. Number 3, you got to have a health directive. A health directive is where you're able to write down all your health wishes. For example, do you want someone to reciprocate you, or you want them to pull the plug? Do you want them to keep you on life support for a certain period of time, or do you want them to pull the plug? You got to put these things in writing, right? Do you want them to embalm you versus not embalm you? You got to have it in writing. Okay, your health directive is very important. And then you need to have a trust. Your trust is used to protect all your assets. All of your assets need to be protected inside of a trust. So all of these things need to be done in that trust. What are assets? Like your home, your car, your bank account, or anything, your jewelry. Is it protected by a trust? All right? Because if you don't have a trust in place, your family will have to go through probate and may end up have to pay what's called inheritance or estate tax, especially for those that's leaving houses behind for their children. Put it inside of a trust. Okay, you can put it inside of a living trust, or you can put it inside of an irrevocable trust. You got to know the difference between the two. That's something we'll teach you as well in our program. What is the difference between irrevocable versus revocable trust? Very crucial for you to know the difference between the two. And there's many more trusts as well. There's special needs trust, there's incapacity trust, there is real estate trust. I could go on and go on and go on for days. Okay. That's why when you build a stronger financial foundation, guys, you want to look at these things and realize that if you have life insurance set up properly, and this is personal and business, all right, this is not just for personal use. This is also on a business level as well. Because when you own the life insurance called a key person insurance or the executive bonus life for business owners, this is a way where you could use that premium. You could put it in a cash value life insurance, and you could write off the monthly premiums as a monthly expenses, and you get tax credit for that. We could talk about more how to structure things like that. But like I said, you're gonna understand growth, right? The goal is to grow your money. And I know we took some time to also go into the protecting your money, because that's what it comes down to here. So once again, if the goal is to grow your money and the plan is to protect it using estate planning with a will, a power of attorney, a health directive, and a trust, that's how you start to understand your money. So that's why I tell you, if you don't know why, you don't know how, you don't have a plan, a goal, and a plan when it comes to your finances, then you don't understand why you need to make money, save money, grow your money, and protect your money. That's what we're trying to teach you. So if you're somebody that likes to learn more, right? If you want to learn more, if this was very crucial, if this was very insightful to you, you learned a lot today, I want to encourage you to do this. I need you to text, right? Text your full name, right? Follow the instructions here if you want to get access to my classes and mentorship. Text your full name, and you're going to text it to this information here. You're going to text it to 321 312 0130. All right? That's where you're going to text. You're going to text your full name to 321 312 0130. Text your full name to this number. All right? If you'd like to get access to our mentorship program. Now, what do you get access to? You're going to get access to mentorship for the next 30 to 90 days. All right? Depends on how fast you want to learn. I'm going to mentor you for the next 30 to 90 days, and I'm going to teach you and help you to formulate all the things we talked about today, plus more. And all you have to pay is attention. Normally, my class and mentorship program, it will be normally about $197 per month. All right? $197 per month to get access to my coaching program and my class. But for you that's watching this right now, you will get access to my class for $197. All right? $197 is what I normally charge. But if you're watching this right now, I'm actually giving access to the first 30. All right? The first 30 will get to claim this for free. So the first 30, if you're one of the first 30 people to text that number with your full name, you'll get access to my class for free. After the first 30 that comes in for this month, it'll be $197. So I encourage you to text right now so that way you can get access to this class. All right? Do not miss it. If not, it'll be $197. Text right now. Be one of the 30. So I just want to encourage you guys. And once again, thank you for being here. My name is Coach Keyon, also known as Mr. Finance, your favorite financial educator, business coach, and author. And I just want to tell you that you are one decision away from changing your future for the better. So always remember that the choice is always yours. Until next time, guys, I see you at the top. Keep winning.